How long does it actually take to raise? And I'll tell you, it's not 3 months. I'm going to break down what it actually takes. There's a version of fundraising that circulates in founder circles. So the deck goes out, meetings happen, term sheets arrive, the money hits the bank. 6 weeks, maybe 8. Clean, fast, done. That version is real. It just has about 6 to 8 months of invisible work sitting behind it that nobody talks about. That overnight raise that made the TechCrunch article, or that founder who spent the better part of a year building relationships before a single deck was sent. The seed round that closed in 6 weeks had a pipeline that was quietly warm for months before anyone called it a fundraise. When the full picture is visible, the timeline stops being surprising. So here's what it actually looks like phase by phase. Phase 1, pre-fundraising prep. That can be between 3 to 6 months. This is the phase most founders skip entirely. It's also the phase that determines whether the actual raise takes 3 months or 12. 99.9% of investors don't write checks to strangers or after one meeting. They're going to write checks to founders they've been watching, people who showed up in their feed, got introduced to someone they trust, or shared updates before there was anything to ask for. The relationship has to exist before the ask does. That means getting into the right rooms, making the right introductions, and being visible in a way that lets investors watch progress happen in real time. Not because it's performative, but because familiarity collapses trust-building timelines dramatically. The deck also can't just be done. It has to be right. The best pitch materials communicate problem, solution, market, traction, data, and team in a way that makes an investor lean forward just after slide 3 or just after one conversation. Most founders go through 10 or 50 versions before it actually gets there. And that's not a failure, that's just truly part of the process. But it takes time that has to be accounted for, and the financials have to be ready before the first meeting, not after. Burn, runway, projections, use of funds, all that needs to be clean, defensible, and stress tested to investors because they're going to ask. Fumbling those numbers in a meeting is one of the fastest ways to lose a deal that was otherwise going well. 3 to 6 months before a single pitch. That's what phase 1 is. Now, phase 2, this is active fundraising, anywhere from another 3 to 6 months. This is the part people picture when they think about fundraising. Meetings, pitches, follow-up. Here's what it really looks like in practice. It's not just one investor at a time. It's 20, 30, sometimes 50 plus. Conversations that are running in parallel. Each one requires prep and follow-up and usually multiple rounds before any real signal emerges. Investors are slow. That's not a criticism, it's just the reality of the environment, and it's their money on the line, so they deserve to be. They have portfolio members, they have LP obligations, and their own operations. So a follow-up email might go unanswered for a couple weeks. A meeting that felt genuinely promising might go quiet for a month, and that's really normal. It's also maddening, and it eats time that most fundraising timelines never accounted for. And then there's due diligence, which starts once an investor is seriously interested. So financials are reviewed, the data room comes out, customers are called, references are checked, and markets are researched. So that process alone can run 4 to 8 weeks per investor. And it often happens with multiple investors simultaneously. Now, 3 to 6 months, and that's if things go reasonably well from previous phase 1 preparation. Now, phase 3 is post-term sheet 1 to 3 months. A term sheet feels like the finish line, but it isn't. A term sheet sign is an agreement to negotiate towards money. What follows is a legal review, and every founder needs their own lawyer, not just the investors, and then comes the negotiations, valuation, board composition, pro rata rights, liquidation preferences, all those fancy words, and in closing documents. Wire transfers, the cap table gets updated. That's 1 to 3 months after the moment when you thought it was over. So the actual timeline looks more like pre-fundraising prep 3 to 6 months, actively raising for 3 to 6 months, post-term sheets 1 to 3 months. So a total of 7 to 15 months from preparation to that money hitting your bank account. Now, for first-time founders, the realistic average sits at 9 to 12 months. That number needs to be built into runway planning, team conversations, and every internal projection that references when we close the round. Not the 3-month version, the 9 to 12-month version. So how to really compress that timeline? It can move faster, and three things actually move the needle. Warm introductions. A credible introduction from someone an investor already trusts is worth more than 50 cold emails. One mutual connection who can say, "This founder is worth your time," collapses the relationship building phase in a way that nothing else does. Mapping out who can make those introductions and asking is one of the highest leverage activities in the early stages of a raise, even if they're just a social media connection. Now, running parallel, so pitching one investor, waiting for an answer, then moving to the next one, is how a raise becomes an 18-month ordeal. Investors move faster when they sense others are looking at the same deal. Momentum is actually contagious. It's kind of like a pool party. When one person goes in, the others are more excited to follow. Then responding fast. Sounds small, but when an investor asks for something, follow-up materials, customer references, a second meeting, the response time is what they're indexing you on. Founders who move quickly demonstrate that they run a tight process. Founders who take a week to reply are quietly communicating something else. Even with all three, plan for longer than what seems necessary. Now, fundraising has a way of consuming everything. 6 months in, it can start to feel like a job, and building starts to feel secondary. And that's when traction goes flat. Now, flat traction in the middle of a raise is a hard hole to climb out of. Irony is that the best thing that can happen during a raise is if an investor asks about growth and it's getting pulled up in a chart and it's moving in the right direction. Traction silences a lot of doubt. So it's going to turn that soft interest more into urgency. It converts maybe into term sheets faster than a pitch deck ever will. And as hard and overwhelming as it can be, the business has to keep moving while the raise is happening. So bottom line, 9 to 12 months is the honest timeline for a first-time founder raising a meaningful round. Start building relationships before the money is needed, or even if you think you want to go through the process. And run the process in parallel. Respond fast and don't let fundraising become the whole identity while the product quietly stalls. The raise is a means, the business is the point. So being a founder is hard. Being a founder who's fundraising is a level of hard that most won't understand, but don't have to do it alone. So be sure to subscribe because I've got weekly videos on how to get and stay fundable.